Young investors often make the same mistakes, which negatively affect the results of their investments. The most common of these are lack of clear investment goals and strategy. Many invest at random, without determining why and for how long they are investing, which leads to unnecessary purchases and failure to achieve their financial goals. Lack of knowledge and research. Investing money in assets without a deep understanding of their nature and without analyzing the market leads to wrong decisions and losses. Lack of portfolio diversification. Betting all on one horse increases the risk of serious losses if the selected asset depreciates. Making emotional and impulsive decisions, panic or greed cause people to buy at the peak and sell at the bottom, instead of sticking to the plan. Lack of a financial safety net. Investing all savings without a reserve fund makes any investor vulnerable to unforeseen expenses. Investing with borrowed funds, buying assets with money that needs to be repaid urgently increases psychological pressure and the risk of defaulting on borrowed funds. The pursuit of quick profits and hot ideas. The desire to make money here and now on one-off hyped instruments almost always results in losses. Neglecting continuous learning and analysis. Refusing to improve financial literacy and learn new instruments leads to repeating the same mistakes. It is important to consider specific strategies and methods that will help you avoid mistakes when choosing investment instruments. The right approach to asset selection significantly reduces risks and increases the likelihood of achieving financial goals. Before you start analyzing investment instruments, you need to clearly define your goals and time horizons. Each goal requires a different approach to asset selection. For example, some instruments are suitable for saving for your children's education in 15 years, while completely different ones are suitable for creating a financial safety cushion. Determine the following parameters: the specific amount and time frame, the acceptable level of risk, the need for regular income or the possibility of long-term capital growth, the possibility of replenishing investments. Fundamental analysis is the basis for a competent choice of investment instruments. It includes an assessment of the financial condition of companies, analysis of industry prospects, and macroeconomic factors. Financial indicators for evaluating companies, profitability and cash flows. Companies must demonstrate stable profitability and the ability to generate free cash flow. Debt level. It is important to assess the debt-to-equity ratio and the company's ability to service its debt obligations. Market position. Analysis of competitive advantages, barriers to entry into the industry, and the sustainability of the business model. Qualitative factors. Experience and reputation of the management team. Quality of corporate governance. Prospects for the industry and sales markets. The company's innovative potential. When selecting bonds, attention should be paid to the following parameters: credit quality of the issuer, ratings from recognized agencies not lower than investment grade, no history of defaults, structural features, the presence of offers and their impact on yield, amortization terms and their impact on cash flows, coupon type, fixed or floating, depending on the interest rate environment. The selection of stocks requires special attention to the following fundamental indicators: financial stability, stability of revenue and profit throughout economic cycles, low PE multiples while maintaining business quality, regularity of dividend payments for dividend strategies, competitive advantages, leading positions in the industry, high barriers to entry for competitors. Sustainable business model. Proper diversification is not just an increase in the number of assets, but their thoughtful distribution. An optimal portfolio contains 25 to 30 different instruments to minimize unsystematic risks. There are several types of diversification: by asset class, stocks, bonds, real estate, commodities; by geography, different countries and regions; by industry, distribution among unrelated sectors of the economy; by currency, protection against currency risks. Set clear limits for effective concentration management. No more than 10% of the portfolio for a single instrument. No more than 15% for a single industry. No more than 25% for a single asset class. Control of debt load when using borrowed funds. Why it matters: reducing concentration risk. When too much capital is invested in a single asset or sector, negative events affecting that asset or industry can lead to significant losses. Limiting the share of a single instrument to 10% and an industry to 15% helps avoid excessive dependence on a single source of risk. Asset diversification and correlation. Spreading investments across different asset classes, stocks, bonds, real estate, etc., with varying degrees of correlation reduces the overall volatility of the portfolio. A 25% limit on asset classes promotes a balance between return and risk, allowing the portfolio to be more resilient to market fluctuations. Debt load control. The use of borrowed funds, leverage, increases potential returns, but also significantly increases the risk of losses. Controlling leverage and debt load helps to avoid situations where losses on borrowed funds can lead to margin calls or forced sales of assets at unfavorable moments. Risk and return optimization. According to Markowitz's portfolio optimization theory, the correct allocation of assets allows for maximum returns with minimum risk. Concentration limits are the practical embodiment of this principle, ensuring a balance between returns and volatility control. Protection against systemic and non-systemic risks. Concentration limits help reduce the impact of both specific risks of individual companies or sectors and systemic market shocks, increasing portfolio stability in crisis situations. Controlling emotions is critical to successful investing. Panic and greed often lead to buying at the peak of the market and selling at the bottom. Ways to control emotions. Follow a pre-developed plan. Invest regularly regardless of market conditions. Focus on long-term goals rather than short-term fluctuations. Avoid blindly following other people's recommendations. Each investor should conduct their own analysis, taking into account their goals and capabilities. Principles for working with information. Study primary sources, financial statements, official documents. Understand the essence of each investment instrument before buying. Regularly update your knowledge of the market and instruments. Conduct a comprehensive review of the investment object. For private investors, this means thoroughly studying all available materials about the company or instrument. Key areas of review: analyzing financial statements and audit reports, studying the legal structure and document flow, assessing the market position and competitive environment, analysis of risks and development opportunities. To summarize the selection stages: learn the basics of investing and define your goals. Conduct a fundamental analysis of potential investments. Pay attention to a balanced portfolio. Regularly monitor the performance of your investments. Adjust your portfolio in line with changing conditions. For investors with limited time or experience, it is recommended to consider ETFs and mutual funds. These instruments provide automatic diversification and professional management at relatively low fees. Choosing the right investment instruments requires a systematic approach, patience, and continuous learning. Avoiding emotional decisions, conducting thorough analysis, and adhering to the principles of diversification significantly increase the chances of achieving investment goals at an acceptable level of risk.